FX Coins, this is Christopher Lewis. Taking a look at the gold futures market, gold has, over the last 2 years, roughly been straight up in the air. And as I look at the weekly chart, despite the fact that it has been very choppy as of late, it still looks very bullish. In fact, one could make an argument of an ascending triangle forming. So, as I go into the bulk of the analysis on the daily chart, the market looks relatively flat and has been flat for roughly 5 or 6 sessions now. But when you look at the totality of the move over the course of summer, you see that it's been a very grindy, somewhat sideways market. But the one thing that I would point out is that the lows continue to get successively higher. I would also point out that the 50-day EMA has been acting like a trend line going back to basically New Year's Day. So I do expect a little bit of support in this area. The question, of course, is why isn't gold moving? And the answer is a convergence of a lot of questions. The first one, of course, is a question of volume. This time of year is typically vacation season, and it's not rare to see markets just drift. And in fact, the last several days in the NASDAQ 100 has been like that. So it's not just a gold thing. But we do have the Jackson Hole Symposium in Wyoming this week, where central bankers around the world will meet and discuss monetary policy. There is a speech by Jerome Powell on Friday that could move the markets if he sounds a bit more dovish than previously stated in several of the press conferences and the like. The Fed funds futures market, it's a futures contract that bets on interest rate decisions of the Federal Reserve, believes by about a 90% shot that the Federal Reserve will cut interest rates in September. So that should be good for gold. The central banks around the world continue to buy gold. So I think that's part of your perma bid, if you will, in this market. We really haven't gone anywhere, but we've never, over the last 3 or 4 months, had any real threat of a breakdown. I think that continues to be the case. If and when we can break above the $3,500 level, then you have a real shot at moving to the upside. I still believe it is a buy on the dips market. But on a move above the $3,500 level, you would take the measured move of $300 from that ascending triangle or the rectangle, depending on what happens next, and extrapolate that for a move to the $3,800 level. On a breakdown below the 50-day EMA, then I think we target the last swing low at $3,300, followed by $3,200. It's really not until we break down below $3,200 that I begin to question some things. So for me, it is a buy on the dip, look for the bounce to get involved type of scenario. And really not much has changed over the last couple of weeks or even the last couple of months, despite the fact that it has been somewhat sideways. It makes a certain amount of sense when you look at the huge move that we've had, that the market may have to take a little bit of time to digest these gains, as markets cannot go in one direction forever. But given enough time, I suspect somewhere in the month of September is really when we start to see things accelerate. In the meantime, the market is setting up for that move. So traders can either focus on short-term range-bound trading or perhaps try to get in for a longer-term move, assuming everything lines up. Again, watch that $3,200 level below for a significant floor.